because we've got a lot to talk about. Welcome back to the IAB webinar series, first one for 2021. We got through, I think we ended up at sort of 40 plus, last year. All those webinars are up on our website. Tiff will share some links during the webinar today, so you can go back and have a look at the webinars that we held last year. We are going to fortnightly this year. The weekly ones were fun, but rather taxing, I guess, on us and possibly even the audience. So we are going to fortnightly from today onwards. So great range of topics that were lined up for you. But we thought it was important to start the year looking at the economic forecast, consumer confidence, ad market, marketer confidence, and understanding where we landed, I guess, at the end of 2020 and how we can plan, have some sort of understanding of what's going to happen in the year and what we can be sure of and what's still in flux. And I've got some brilliant speakers today to help flesh that out and really give us an understanding of where we're at. We will be doing a Q&A at the end. This is an amazing opportunity for you guys to ask these guys questions. I will hog it if you don't, so please pop the questions in the Q&A box and we'll try and get through to as many of them as possible at the end. Feel free to send through notes or chats in the chat box as well. Make everyone feel welcome and happy and involved. And hopefully we'll cover a lot of ground that should be of interest. So to introduce you to our panel today, so we've got myself. For those of you who haven't met me, my name is Gai Le Roy. I'm lucky enough to be the CEO of the IAB in Australia. I'm going to kick off with a chat with Daniel Knapp, who is the Chief Economist for IAB Europe. I'm very jealous that the IAB over there has a Chief Economist, and I'm desperately thinking of ways that we can do the same. But Daniel and I will be having a chat around, I guess, the European market, influence of other markets, overall trends, and I guess comparing markets to an extent. So we'll have a bit of a chat around that. Then we're going to be joined by Charlie Nelson. Many of you hopefully have heard Charlie's wisdom over the years. He's an economic forecaster, and we'll really take a look at the sort of the macro side of things, consumer confidence, trends in different verticals at that broader level. And then we're going to be joined by Genevieve Reynolds from PwC. Jen's part of the CMO advisory team who not only put out the wonderful Outlook report, so looking at forecasting. So I'll have a quick chat about where we're at today. Jen's going to have a little bit of an idea of where we're going forward. They put out some new forecasts at the end of last year. But I guess as importantly, the CMO advisory group are doing what it says on the tin. They're advising CMOs, talking to CMOs constantly around their marketing plans, whether that be paid media or the broader marketing budget. So Jen will sort of bring us home with that state of play in Australia and that marketing investment. And then we'll have a chance for a Q&A at the end. So just a few slides from me up front to help set the scene, and then we'll chat to Daniel. I think everyone's probably seen within the trade press a lot of the stuff that the IAB have put out locally and globally. Media consumption on digital devices last year was incredibly hot, increase in numbers. So overall on desktop, phone and tablet, total time, which is already a big bucket of time for consumers, was up 19% in Australia. So really big jumps there. You can see the chart on the right. We had some incredibly big jumps early on in the pandemic, that around April, March, particularly from a text and news point of view, really big jumps. This data doesn't include CTV, which, as we know, has also had huge jumps. But all devices saw an increase. Smartphone was a little bit more static as people flipped to desktop a little bit more, but overall the whole market was up. So we shared some data in market last week with the release of digital content planning data. Tiff will share the link for that, but just giving you an understanding of the breadth of different media owners, brands, areas that people are consuming, whether it be news, functional, entertainment across the board. So that's the consumer side of the story. This is looking at the revenue data that we put out every quarter with PwC. This data set ends at the end of the September quarter. I'm going to give you a bit of a teaser of the December quarter in a minute, but this just gives you a bit of a feel of the market. The Australian ad market overall has had a couple of years of pretty average, I would say, growth. So we went into the pandemic on a fairly low base and a fairly flat market. So you can see suddenly September, the market starting to come back to where we were across the three different types of inventory that we look at. So search, display, and the classifieds area, which is the listing side of things, which is a really interesting and important thing to look at. So a lot of people on the call will be very focused on the display market, but classifieds is a really good read of overall consumer confidence, job listings, car listings, etc. So what I'm going to show you next, I probably shouldn't be showing you, so get very excited. We do a bit of a monthly tracker with some of our larger members in terms of what's going on in market. I'm not going to give you absolute numbers, so you don't get that much, but this will feed into our December quarter PwC report, which will be released in about 2 weeks. So that will have a look at the calendar year as well as the last quarter in depth. Everyone I have spoken to in the last month or so has been amazed at the market comeback in the last quarter. So you can see from the numbers there. So the overall display market, which includes video, includes all the different types of display, whether it be native, in-feed, etc., up 21% year on year. It's almost getting like a broken record, though. I know my broadcaster friends don't think that the video is driving growth. So to have year-on-year growth of 46% is quite incredible. A lot of focus, obviously, on that long form side of things, particularly BVOD in that mix, but very healthy December quarter. The one area that was not as high in terms of growth, and classifieds historically is not, particularly coming in December, not the strongest month. A lot of the sort of the more functional things sort of take a bit of a break, but that area hadn't come back quite as strongly as some of the other areas. But you can see on the charts on the right, 2018 and 2019, there'd been very little growth at that sort of overall display area, but you can see 2020 a very positive story, and I'm trying to get as much intel as I can on how the March quarter's looking, but so far there still seems to be very positive noises around investment in the ad market. So it's nice to be able to bring you a positive story. So I'm going to bring Daniel in now, and we'll hear from him on how he's seeing the market, which I know is not just one big homogenous market in Europe. Daniel, what's happening in your part of the world?
Well, thank you for having me, first of all. It's great to be here. I can say that we had a similarly positive Q4 across nearly all media categories in Europe in aggregate, but it was a bit of an irrational exuberance. So a lot of relief to spend again, to tap into the Christmas business as usual. So we probably saw around in digital on a 17-18% increase year on year in terms of net spend, but this hasn't carried forward into 2021. Now, overall, we believe that the ad market will recover, so we'll recoup the majority of the losses. Digital will actually exceed expectations, so we're going to see a return to double-digit growth. But the first quarter is still fairly muted. So we, in particular in media like television, also out of home, where you typically have some advanced bookings, we saw quite a bit of conservatism across marketer categories in Q4, and still we do not know at large how March is going to shape up. So for digital, we're currently forecasting around +5 year on year in the first quarter. Then in the second quarter, of course, we have very easy comparatives because we did have that massive tanking of the market, very sudden drop at the end of March, beginning of April. So we're seeing here around +15, 16% growth. And then we're going to see this, just in the shy double digits for the remainder of the year. Also, as we are seeing the vaccine rollout, which you have probably seen in the news, has been pretty suboptimal in the EU at least. As those vaccines become available, we see a return to spend. One thing I should say though is that we can learn a lot from 2020. I don't really see it as this cyclical blip. You know, when we had the financial crisis 08, 09, we saw a sudden market collapse and then a rebound and then business as usual. I see this really as, and you've highlighted this actually in your introductory slides, as a kind of structural transformation of the ad market. And although it was a hard time, I think we've seen so much acceleration of change, of new formats, of a focus on outcome-based marketing, really of seeing how important digital advertising is to drive sales, that we really have a completely new picture of what digital can do. So I kind of saw it as a bit of a live experiment. And we just released our full year data, and digital grew plus 2.1% in 2020. That's against traditional media were down around 19.4%. So there's a massive gap, and we could see actually this bifurcation of ad spend, digital versus non-digital, going to continue in the years ahead.
So you've talked about, I guess, the difference within the inventory types. So even within digital, if you look at both, I guess, on the consumption side, but then also from a buy side, are you seeing different channels, different types of inventory coming through more strongly? And I'd like to pick you up on that sort of that outcomes-based side of things. Is that referring to very performance-driven metrics, or is it a broader discussion?
That's a really interesting topic, actually, and there's no clear-cut answer, because there were, I think, chapters, like in a good drama, you know, that there was the Act 1, Act 2, Act 3, and so forth in the last year, because every media category within digital performed quite differently. Let's go back to March. We actually saw that performance-based media or biddable media, they dropped extremely suddenly. They went from 100 to 0 essentially, much quicker than television and other media. Because of course, you know, you got in those channels, you got that switch on, switch off nature, so you can react very quickly. Whereas you have so many advanced commitments in other media. So we saw performance channels tank really rapidly, but then they came back the quickest. So, of course, we saw a perseverance of social. You've seen it in the SEC filings, Facebook and others. But other performance channels as well, as marketers quickly turned to kind of an emergency mode to kind of drive sales during periods of lockdown and to capitalize on the e-commerce trend, which I know is also exploding in the US, so in Australia as well. And in the UK, for instance, we saw an acceleration probably around of kind of 8-9 years within 3 months. So that came back very quickly. But then as we eased out of summer, suddenly brand spend came back, in particular around video. And video also isn't a clear-cut category. If you dive into the Google filings, you'll see that at the beginning of the year, performance-based YouTube inventory was doing particularly well. But then kind of the branding video came back, and we saw a massive explosion of awareness-based campaigns with moving images really, really capture people's attention in the fourth quarter. Search has had a bit of a muted year, I'd say, mainly due to the strong exposure of the travel sector, which hasn't recovered. And we've seen a similar picture in classifieds, actually, where we've seen a stronger impact during the beginning of the pandemic and not a recovery at all. So it was actually the only category within digital that posted a negative year-on-year growth in 2020.
And in terms of the experimentation that marketers have been doing, changing the inventory that they're buying, what are they looking for? Are they looking for something different from the sell side in terms of speed of metrics, types of metrics, partnerships, trust? I imagine all of that is a little bit changed.
Well, marketers have adapted in a quite interesting manner. So again, at the beginning of the year, we saw panic reaction and spend collapsed. But there was a kind of change in correlation as the year progressed overall. And I come to the sell side in a bit, but this is really, really, I think, important background, where as we entered in, the post-summer lockdown, suddenly we didn't see a decrease in spend in areas that were under strict lockdown. Or at least there was a much weaker correlation. So we found that in Q1, the net impact of a lockdown was around 18% net. But although lockdowns were a bit lighter in the second phase of 2020, it was around only 6 or 7%. So marketers have learned to deal with the pandemic, and they have adapted their media plans. But it wasn't just COVID that 2020 brought us. It was a perfect storm with Black Lives Matters and other things. And there has been a particular attention on the sell side, of course, on brand safety and brand suitability, because blacklists and whitelists have often unjustifiably hindered premium publishers to monetize their massive audience attention. And that has also slightly changed throughout the year, but not to the extent that we expect. Overall, there is now, though, a bigger emphasis on outcomes. And again, it's not a single factor that drives this, because everybody is also looking ahead what's happening with the demise of third-party cookies. So we see a stronger focus on contextual solutions. And also, whereas at the beginning of the pandemic, a strong focus on the OMP and programmatic, more emphasis later on PMP, and we saw marketers really expect more from publishers in terms of premium environment, but also evidence. Evidence, does it drive awareness? Does it drive brand suitability, favorability? So there's really a strong focus everywhere on providing robust empirical evidence that marketing really works.
We've got some interesting research coming out, and you guys have done, I know in Europe, similar stuff in terms of metrics, particularly on the video side of things, that the objectives they have versus the metrics they measure. So when you're talking about all those brand metrics, I love hearing that. I just get a little bit scared that they're not actually tracking them accurately. So I guess as an industry, you need to make sure, particularly as you said, with the identifiers and signals going, that we have some efficient and effective and robust ways of doing that without over surveying all our poor visitors, site visitors.
I think that has been a major realization among everybody from the buy and the sell side in 2020, that in digital we have this paradox, right? We have more data than ever, but less than ever we really know what it means. There are so many fragmented ways of measuring and counting things. And it's not just about attribution. It's not just about driving business outcomes, but it's also about things like the programmatic supply chain, which is under heavy scrutiny by regulators in Europe, for instance. So there has overall been a focus on what data do we have, what does it mean, and how can we as an industry really find common ground, find a consensus on how to interpret this massive array of data that we're getting from digital channels.
I have two more very quick things because we're going to have to move on. So you've talked about, I guess, the perfect storm, things like Black Lives Matters. Obviously, it's been a huge year with the American election impacting all sides of things. I know in a webinar that you did for IAB Europe, you talked about the ongoing separation of GDP to ad investment, and even a separation between paid media and overall marketing budgets. When you're looking at forecasting now, it feels like there's a lot of things that are no longer as accurate input data points. How's that changed how you're forecasting and looking at the market?
You're touching on one of my absolute favorite topics, and really just as a reminder for all the other data geeks out there. We always saw, of course, that ad spend overreacts to macroeconomic trends. If the economy is well, ad spend goes up a bit more than the economy, but if the economy goes down, ad spend really collapses. But we have seen that, at least on the positive side, we've seen a collapsing correlation, which means when the economy grows, ad spend, in mature ad markets is growing in line with or slightly below nominal GDP. And we've been wondering, why is that the case? One is, of course, that some of the major underwriters of the ad economy, some of the big FMCGs and auto companies, they're not doing that well anymore. They're disrupted themselves. And we often, in the ad industry, really only focus on audience changes and other things, but we have to see what's fundamentally changing in the businesses of the big kind of mass consumer goods. Because it was always the relationship between mass media and mass consumer goods that drove the ad economy. Now, that's one thing. But the other is, it doesn't mean that less is being spent on advertising. The category of advertising is being rapidly expanded. Of course, we talked about e-commerce, but also experience design and website design and other things, where it's clear that interruptive messaging isn't really the only way, or maybe even for some the primary way of reaching consumers. There's a much more kind of integrated perception of what counts as marketing spend. And it could even be things like logistics, service design, and so forth. So if we count all those things back in, beyond my traditional paid media forecasts, we still see a continuation of that correlation. But bottom line, macroeconomic trends have always been very good at forecasting what's happening long term, but never really short term. So we always use GDP, household consumption, industrial production to kind of forecast out kind of a baseline 5 years. But in the running year, we focus much more on actual company filings, outlooks, interviews, because we all know, although we are a data-driven industry in a sense, it's not necessarily always a rational industry. And we know that relationships matter. And that same sense also, listening on the ground, what's going on, is very important to smooth out those long-term predictors.
That's good. We'll end on that because it means we've still got a job for a little while, Daniel. Yeah. Fantastic. Thank you. And we'll come back. Daniel will join us for the Q&A. It is 1 a.m. We're in Germany. So if you start nodding off, Daniel, we won't be offended.
I think it will be far too exciting for that. Let's stay
Fantastic.
on. Thank you.
Awesome. Now we're going to hear from Charlie, who's going to give us his understanding of, I guess, the Australian macro market. Take it away, Charlie.
Thank you, Gai. I'm just going to share the screen here. Well, the economy is recovering pretty well, in fact, better than the Reserve Bank of Australia expected. But it won't be back to where it would have been without the pandemic by the end of 2021. Sorry about that.
We'll just get you to go on full screen. Yeah, perfect.
Yeah, sorry about that. There's certainly a degree of uncertainty about things. In the economy, we've got consumer income uncertainty because of high unemployment and a high proportion of employed people wanting to work more hours. Plus, of course, the government is withdrawing income support. It's scheduled to expire at the end of March. So unless it extends, there will be much slower income growth. Health uncertainty exists because we don't know how quickly the population will be vaccinated and how effective the vaccines will be, especially regarding mutations. This suggests consumer caution about travelling and other activities for a while yet. Australia's population growth rate has slowed from 1.5% to 0.5% because we've had no net migration during 2020. And this is likely to continue for a while yet. So we're going to end up in a situation by the end of this year where the population could be up to 350,000 lower than it otherwise would have been. And of course, that affects demand growth. GDP growth is recovering strongly, as this chart shows, but we would have to have a very fast rate of about 7.6% to get back onto trend by the end of this year. That's not going to happen, of course. Forecasts currently centre on 3.5%, which is obviously a good recovery, but it'll be some time before we are back to where we ought to be. Employment growth too is recovered much of the lost ground. So we're almost back to where we were at the start of 2020, but it'll be a long time before we're back to where we would have been in the absence of the pandemic. We've got to accommodate the employment needs of 2 years of school leavers and tertiary education graduates before we can get back to where we ought to be. If we look at household disposable income, that's quite a different trend. It's been very strong in 2020 because of government income support, but it must slow very soon because that support is being withdrawn. Also, wages growth will continue to grow at the record low rate that they have done lately because of continued high unemployment. Household consumption spending, this includes all goods and services, is recovering from recession, but it's very unlikely to recover to trend in 2021. We'd need a very strong growth rate, and that can't happen because domestic tourism and education, both major industries, are unlikely to be fully recovered in 2021. So they'll be operating well below capacity. Here's a brighter chart. Retail sales boomed as people stocked up for a period of cocooning and working from home. Savings from not spending on travel and commuting, plus government income support, financed this spending. The rate of growth must tail off as income growth slows and less durables need to be purchased. Another bright note here is that new vehicle sales have increased significantly in November, December and January after more than 2 years in decline. This market's been helped by instant tax write-offs, and of course there has been some pent-up demand during the restrictions for COVID-19. So sales are going to increase in 2021, not to record levels, but it's a very positive side, and this is mostly being driven by private buyers. This is the first data that we have for January, the new vehicle sales that came out very quickly, and it's a terrific story. Now here's another good story, a boom in first home buyer finance commitments fueled by pent-up demand, record low interest rates, drawdowns of superannuation, government assistance, and years of saving by young people. Dwelling approvals for houses hit a record high in December. Although approvals for apartments are down, nonetheless, the total dwelling approvals are up near record levels, and this is terrific for the economy. How would you spend a spare $1,000? The allocation to saving, which is the blue line here, has increased very substantially to a record high. This is consistent with the household saving ratio, which has increased to a record high of nearly 20% of all income being saved, up from around about 5%. So it's a major change. On the other hand, intentions to repay debt is rather low. It's a record low because, of course, interest rates are so low. So that leaves spending. Its intention to spend is above average. $289 would be allocated to spending, which is higher than the long-term average. But if we break that down into discretionary spending and household bills and so on, we can see that household bills would absorb over $180, leaving only $107 for discretionary spending. So there's a lot of people who don't feel they have spending power and would prefer to do other things with any spare income, especially saving. Could that saving come out as spending as time goes on? Well, yes, of course it could, but these are the things that people tell us that they're mostly saving for. The biggest one is precautionary saving, which is 15% of all adults. Other than that, the most frequently cited items are holiday, which of course we can't take fully yet because of concerns about COVID and borders being shut. Residential property to occupy is very high, and that presaged the big boom that you just saw in first home buyers' commitments. And we've got saving for retirement, which has gone up recently, and saving for a car also lifted just recently, which is underpinning that big lift in new vehicle sales that we just saw. We asked people in surveys about the likelihood they attach to certain events occurring in the future. This is important to us in forecasting because people's expectations drive their behaviour. And we can see here that the most likely items they expect to happen on a scale from 0 to 100 is that unemployment will be high and the economy will be slow. So that's a sign of caution ahead, I think. And the third one there is clear signs of global warming. And if we go down a bit, the world will recover from COVID-19 50%. and down a bit later, another major disease outbreak, 42%. So clearly there are expectations about health problems for a while yet. Again, that suggests caution. So we're talking about caution about the economy and health. This is our economic fear index. It's based on expectations about the economy and unemployment. And you can see the index was still above average in November, but below the level of September. And it's also below late 2008 when the GFC emerged. So it's economic fear is up, but it's not at its highest level by any means. So people are feeling just a bit more confident about the economy now than what they were. We also asked people in surveys about what they expect to be concerned about in the foreseeable future. This chart shows the proportion of adults who express a high level of concern, that is 8, 9 or 10 on a 0 to 10 scale. And the cost of living and climate change are the biggest concerns, followed by the health of you and your family and having enough money to live on. Also security of personal information, which is a very high level of concern. So these are the things that consumers will factor into their behaviour in the year ahead. So to summarise then, we can see there's a degree of uncertainty about the economy and health, and this will mean as incomes slow, that we'll be still improving, but not as quickly as we would like. But here's the final very optimistic chart. This is business confidence and conditions, and they're both recovered very strongly at the end of 2020. And that's a very good sign for advertising investment. Conditions is an amalgam of sales, profits, and employment, and they're all up in December. So I think that the advertising industry can look forward to a better year, and well, we'll hand over to Jen to let us know about that. Thank you.
Thanks very much, Charlie. I'm going to now share my screen. Wonderful. I'll just go big screen. There we go. Great, so I'm Jen from the PwC CMO Advisory, part of the team who released the COVID-19 edition of the Outlook in November last year. So our report focused on the impact of COVID-19 on consumption habits, consumer revenue and ad revenue across 12 distinct segments and across the industry as a whole. So I'm going to take you through some of the trends that we analysed and modelled, our forecast for the local market, and what we're seeing in market early in 2021, specifically with regard to how marketers are apportioning their budgets and some of the key considerations they have when doing so. So ultimately, the challenge for entertainment and media companies remains the same. It lies in capturing share of consumer attention and subsequently monetising that share. But what we're seeing is evolving habits driving new business models and opportunities across the whole sector. So in terms of what we've seen throughout the COVID-19 pandemic and throughout 2021 and some of the trends shaping the industry, we've just outlined 4 of the key ones. So first of all, consumer habits can take a lifetime to learn, but just a lockdown to lose. So hard lockdown in Australia impacted every single part of the media sector. And of the 12 sectors that we covered, 7 of those were severely impacted in 2020. And we're finding that some of the trends or the impacts are likely to stick. So for example, and most notably, COVID-19 pulled forward digital consumption habits that would have occurred in future years due to increased connectivity and consumption of digital products across all target markets and audiences, which has had a significant impact on the state of the market in 2020 and the growth trajectory going forward. We're also seeing that subscription-based models are driving much of the growth, but most are ad-free. So throughout the pandemic, we saw an increase in video streaming and SVOD consumption and subscriptions, as well as an increase in the number of consumers paying for news content. In most sectors where the revenue is made up of both consumer revenue and advertising revenue, where ad revenue declined as a result of the economic environment, often it was consumer revenue that helped to offset some of that decline. And what we're seeing is that the market will reach a tipping point. Globally, consumer revenue or spending is forecast to overtake ad spending within the next 5 years. And closer to home, locally, we expect to see that within around the next 7 years locally. So what that means is that entertainment and media companies are increasingly in the business of delivering experience and content directly to their consumers and not delivering those labels to advertisers. I think that's really important for us to note as the marketing community or as advertisers, because every moment that a consumer is spending with a non-ad supported channel is a moment that they are not necessarily spending with an ad supported channel. Thus, it's harder to reach them. This can drive inflation of CPMs, etc. But ultimately, it really makes the job of marketers and media planners very important in order to ensure that marketers are reaching the right audience at the right time in those ad supported environments. We're finding that, again, the consumer is in the driver's seat. They create demand, and what we're finding driving preference is absolutely content. So it's important to note that consumers aren't loyal to media or entertainment brands. They use these brands or platforms, services and products to seek out and then engage in content that they enjoy. So what we're seeing locally and globally is that the battle for content is really heating up. There are some local examples that we've just seen in the last few weeks, being Disney Plus bringing on the Star catalogue, which has rapidly expanded their catalogue with content such as that from 20th Century Fox, making their service more attractive to an adult audience, for example, and some surprising additions such as Stan's deal with Rugby Australia late last year, which is not necessarily something that we would have predicted 12 or 24 months ago. So reconfiguration is underway, and although there will be some challenges for entertainment and media companies as we move beyond the pandemic, the digital migration and some of these new behaviours have helped to pull the future forward, and we believe that it will generate opportunities across all of the sectors, which I'll get to shortly. But first, just a bit of a broad look at the forecast of global entertainment and media outlook in Australia. So our outlook, which was released in November 2020, focused on three possible paths of recovery and their implications. Specifically, the three scenarios that we mapped were positive, which is a really rapid return to pre-COVID advertising and consumer expenditure, which had a minimal ongoing negative impact from the pandemic. We also looked at a gradual or midpoint scenario, which looked at about 18 to 24 months of recovery with modest return to pre-COVID trajectory. And finally, a negative scenario. This was primarily linked to health factors, ongoing lockdowns and things like that. But for the focus of this presentation, we're going to focus on that midpoint or the gradual scenario. So as you can see, the market is predicted to have declined 4.5% in 2020, but it's predicted to return to growth in 2021. Specifically, ad revenue is forecast to have suffered a double-digit drop of around 11%, pulling around $15 billion out of the economy. Now, that's due to, obviously, economic pressure facing many industries and brands, as well as some brands' limited ability to supply, serve or operate. So, as an example, the travel sector obviously had limited ability to operate, therefore, much of their investment was pulled from the market, which to Daniel's point earlier, affected some specific categories within digital specifically. And it's also due to entertainment and media companies' increasing tendency to focus on monetizing content via direct-to-consumer revenue rather than just through advertising. Consumer revenue is less impacted, and looking forward, we expect the market to return to growth in 2021, with advertising reaching pre-2019 levels by 2022. It is important to note that these figures were based on data that was available as at the end of the September quarter, and we have seen some more recent data from the market, which is green shoots. So specifically, we've seen SMI report strong year-on-year growth in both November, December, and earlier Gai obviously took us through some of the growth that's been driven from the digital market. So broadly, growth is being driven in the last quarter of last year, and similarly, we expect in 2021 through mainly TV and digital driving a surge. A little bit of a look at some of the closer look at some of the individual segments. So we've mapped some of the key segments into three buckets. Now, while there are varied paths to growth, reconfiguration is key, and we believe that opportunity is the uniting factor. So first we have the recoverers. Now, the recoverers were impacted by the pandemic, but to varying degrees across that individual segment or sector. So I won't talk to all of these because in the interest of time, but pulling out a few, if we look at internet advertising, for example, we've spoken about the fact that COVID-19 pulled the future forward and advanced Australians' digital consumption. And as a result, it was a relatively flat year from 2019 to 2020, and we expect future growth as we expect the consumption behaviour to stick. Daniel and Gai have already talked through some of the really high performers within the sector. We saw video grow 2019 to 2020 at around a 19% growth rate and expected at a 20% CAGR going forward from 2019 to 2024. We've also got our rapid rebounders. So these were largely and significantly affected by lockdowns, and hence the availability of monetizing audiences due to really decreased consumption. So I think both of these channels speak for themselves. Music, which is largely made up of live events, was severely impacted. More than 90% of revenue was taken out of that market. And similarly, out of home had trouble really monetizing their product, given it relies on reach and movement from citizens. But we expect that in both of these cases, as the world returns to a COVID normal or in the future towards a pre-COVID normal, we expect consumption to rapidly increase in line with the new environment, and we expect advertising revenue to follow. For out of home, the CAGR from 2019 to 2024 is expected to sit around 2.34%, and driving growth there, we expect increased digitisation, which has driven much of the growth of the sector in the last few years, although that is starting to flatten given much of the inventory has already been made digital. We also expect programmatic trading to drive some growth in the sector, although there is a requirement for some advancements in terms of the tech use and processes in order to sort of truly facilitate that method of buying in this local market. We also expect marketers increasing investment in brand-led channels to help prop up the out-of-home market in the coming years. And finally, we have those that are structurally evolving. Now, again, these media were significantly impacted, but they're undergoing structural change to meet this new shape of demand driven by changes in consumer behaviour and consumption. So taking newspapers as an example, we saw an increase in news consumption throughout the pandemic, but unfortunately that consumption wasn't the market wasn't able to translate that into steady or growing advertising revenue because of COVID-19 driven factors. On the flip side, digital news circulation offsets some of that decline, and it presents a really strong growth opportunity for the sector, with a predicted CAGR of 11.93% over the next 5 years. And we've already seen digitisation rapidly and that's something that we expect to continue to see. So finally, locally, we're seeing 4 key considerations in the marketing and advertising landscape, which are driving investment decisions. So first and foremost, we're seeing this broad acceptance of the important role of brand and subsequent investment in brand-led communications. So we're finding that marketing teams are acknowledging the importance of balancing both brand and retail. And what that's resulting is the fact that the market is starting to really correct itself in terms of that ratio of brand versus retail. The implication for the market is that advertising investment will favour channels and formats that meet brand objectives and require context. But what I think is really positive to see, and something that I think that we can continue to talk about as an industry, is that there's this recognition that channels can do both. They can do both brand and retail. I think in the past there's been sort of this false understanding of a channel can either do brand or the channel can do retail, and there's no in between. I think what marketers and advertisers are really looking for from media companies and from consultants and advisors is how to use channels in their best way to elicit the right responses and to drive the right objectives. In a brand context, it's clear that the effective use of brand codes, creativity, and context is key. We're also finding that reach of ad channels remains a primary criteria for investment, especially as subscription services continue to take hold. So really, as pressure on budgets continues, we're finding that marketers and advertisers are looking to partners or environments that can drive scale and importantly, be able to back that scale with intelligence via credible data offerings. This allows advertisers to know that not only are they able to reach a large proportion of their audience, but they know that that's a qualified audience. Being able to deal with fewer suppliers who can deliver scale drives ease of transaction. It limits the cost to execute campaigns, and thus it drives efficiency. So media companies that operate across networks, geographies and channels will be preferred in the future, and we expect that this is likely to drive continued bifurcation of the industry, with both scale and intelligence being crucial for growth. And we expect that the media companies will continue to invest in both scale and data in order to meet this demand from advertisers. We're seeing a continued shift of investment to digital channels and acknowledgement that advertising doesn't just drive mental availability through reach, but also it serves the purpose of being physically available at a point of purchase. So we've spoken a little bit about the rapid increase in e-commerce transactions, and that's certainly something that we're seeing in the local market. And as a result of the shift, we're seeing that businesses, or marketers more specifically, are investing more heavily in data management, online experience, and importantly, online distribution, which is a key driver of the success of many of the biggest media platforms. Going forward, we're expecting an increased focus and investment in digital off the back of this, knowing that that will not only drive reach and recall via mental availability through paid advertising, but also allows brands to be present during the path of purchase and at the time of purchase. So similar to have a shop sign out of your shop on a high street, advertisers are realising that they must be present at the moment that consumers are shopping, and consumers are shopping online more and more. And finally, we're seeing a continued and increased focus on working media, efficacy and measurement. So it comes as no surprise really that as advertising budgets are squeezed and the pressure of those is sustained, marketing teams are really under to prove the efficacy and efficiency of these to their boards and to their C-suites. So what this means is that we're seeing marketers not only focus on the proportion of their total investment that goes towards working media or reaching the end consumer, but we're also seeing them prioritise and invest in environments where there is proven return. So that's playing out is that marketers and advertisers are sort of looking at their supply chain and trying to pull out any wastage, whether that exists in the way that media is transacted, whether that exists in their payment or contracts with third parties like consultants or advisors, or anything internal in terms of multiple tech licenses, et cetera, that might have some duplication. We're also seeing that they're investing more heavily in market mix modelling and econometric modelling, especially with the knowledge that they need to measure the impact and performance of brand activity as much as they do retail activity. And similarly, they need to measure the impact of multiple channels working together as much as they do certain channels in isolation. Its measurement is, an issue right for sorting. And while we've come a long way, I think there's a longer way to go. But what we're absolutely seeing is that marketers are absolutely committing and committed to prove the validity of their investment to the C-suite in order to continue to gain or be awarded investment to ultimately grow their brands. Now, by no means is this an exhaustive list. There's many more trends that we're seeing in the market, many of which are outlined within our Outlook report, which I encourage you all to read. But thank you, and I will pass back to Gai.
Thank you so much, Jen and the team. I'll be re-watching this video a few times, and I'd recommend anyone who's on here sits down with their CFO and their sales and marketing team, and it will give a lot of insight into planning for the next financial year, which, believe it or not, will probably kick off sort of next month for most companies. So we'll make the recording available and the decks probably around next Tuesday. So anyone who's registered will get a link to all those resources. So you'll get a chance to dig into the data a little bit more. We haven't got a lot of time for questions. We've had a couple through, and I might just kick off with one that I find really interesting, and I guess it's around the vaccine. and it's was chatting to one of our members. It's Tonic Health Media, or Tonic Media as they're known now, do a lot in the health space around, I guess, the vaccine being the biggest campaign, should we call it, globally, messaging campaign that we've seen for a long time. Connected to that, I guess, is I guess over the last year or so, there's been a lot of misinformation, a lot of conspiracy theories, a lot of things that are impacting confidence when it comes to handling of COVID. Are any of you seeing any, I guess, changes in, particularly Daniel, I guess, changes in behaviour in people consuming QAnon content? Are we seeing it more marginalised rather than in sort of mainstream media? Do you see a difference in the way that sort of those messages, the misinformation messages, are resonating?
I think there's, first of all, a completely new way on how they're spreading. I mean, we've seen a progressive erosion of gatekeeper roles that media are playing, just because of the kind of direct-to-consumer or relationships that many opinion leaders in this space have, be it through the traditional scaled platforms, but also through the massive emergence of newsletters, things on Substack, and so forth. So it's much more difficult to control this messaging than it ever was before, and there has been not just around COVID, but over the vaccine, but in general about misinformation. And there have been kind of two strands of kind of debate on how to tackle this. And one has been really the camp that algorithms solve it all, that we need a kind of data-driven algorithmic approach to sort out through misinformation. And if you listen to kind of recent kind of Congress hearings in the US, that has been advocated a lot. However, there have been some voices that said, well, number one, that'll take a very long time to develop. We're not there yet. And also, there's kind of so much nuance in messaging that these kind of scaled approaches don't really do the trick, that we need kind of proactive rebuttal of these messages through a journalism, through more tailored interventions by other experts. And as usual with things, there's currently a hybrid, but I think in particular, news brands have a kind of strong kind of obligation, but also possibility to dispel some of these myths. And you're right. I mean, it's a massive awareness campaign for brands. I mean, there's, in a sense, engaging in political issues, which this is. There's a lot to lose, so it's easy to get something wrong, but also there's really a lot to gain. I think the jury's still out how it's going to work, but I see that it's really a time to be proactive and to not expect platforms or others to police content, but to proactively release a different messaging.
Thanks for that. I guess on the same sort of thing, had a question through from the wonderful Megan Brownlow for Charlie around consumer confidence and how closely it's tied to political decisions, particularly in Australia with border closures. We've obviously had a little bit of a blip in Melbourne overnight and some changes there. How reactive is that consumer confidence to these types of changes?
I think we've already seen the biggest impact on consumer sentiment. That was 10 months or so ago, and it's gradually recovered, and I think it's pretty resilient now. I don't see that the events here in Melbourne will change things. We've got good procedures now for dealing with the outbreaks. We didn't do so well initially in winter, but we were able to control that eventually. The population was very good at behaving itself, and I think we'll also be very good at accepting the vaccine. I think the survey suggests well over 2/3 are very happy to take the vaccine. So I think that gradually consumer sentiment will stay strong. Their biggest concerns, I think, are more financial than anything else at the moment.
Yeah, okay. We're running out of time, but I've got one last question. I could go with about 10 different questions, and it's probably most suitable for Jen, and it's around the change in commerce behaviour, particularly for marketers who, you know, last year we saw a big uptick locally in smaller domestic brands as people were worried about supply coming in from other areas. You saw some really innovative companies grabbing market share and some traditional companies scrambling. I'll use that word without sort of apology, scrambling to get their e-commerce and digital transformation up to scratch, particularly some of the older, more traditional brands. Do you see it, I guess, staying with those innovator brands? Where do you see the balance coming out between smaller DTC to traditional brands catching up and being able to get their share back?
Yeah, look, I think that the focus that some of the more traditional brands have had on e-commerce and getting their digital experience right will not go away. And I think that probably the fact that the pandemic pulled forward that behaviour, which was, you know, e-commerce was always going to grow. I think it pulled it forward quickly. It meant that these brands had to really get their digital environments in order very quickly. And I think that that is not a priority that they're going to let drop, even if the vaccine comes in and as, you know, COVID becomes hopefully one day memory. But to your point, I think that the trend in terms of how consumers are in some ways prioritizing, but local brands, but also direct to consumer, I don't think that's something that is going to go away. The direct to consumer sector is growing, it's innovative. The way that they're using digital channels in particular is not only sort of market leading and extremely exciting, it also, what we're seeing in, you know, many brands, especially in sort of beauty sector and things like that, is they speak their consumers' languages in the right environments. They are so beautifully aware of what their brand is and what it stands for, and all of their consumer touch points speak to those to their brand. For example, the way that things are delivered, the way that their website's set up. So they're sort of ahead of the curve in terms of what consumers are demanding from brands when they're shopping online. And I believe that we're definitely going to see growth in the direct to consumer market in terms of how people are shopping. But I also think that the traditional brands have been sort of frightened, I guess, by their knowledge that they probably were a little bit behind in terms of that sector and their digital experience. And I don't think that their focus is going to wane as the pandemic is left in the past. And I think that we as consumers can expect a really sophisticated digital environment going forward.
And I guess from an understanding of attribution and consumers, large and small, are going to have to reconfigure a lot of things with changes in cookies and IDFAs, and so everyone's got a chance to do a bit of a reset. I'll put it in a positive light. Thank you all so much for joining us today. I'd love to follow up on a lot of things with all of you, but really appreciate you sharing all your knowledge and your insights, and hopefully the audience have appreciated it too. Our next webinar in a fortnight is looking at video, and actually this is a nice tie to IAB Europe, because we did, I won't say steal, but we were inspired by the IAB Europe Attitudes to Video Advertising study. As we know, we've had a number of years of, you know, amazing growth in video advertising, and thought it was a really important time to talk to agencies and marketers around their plans, their need for different types of digital measurement, cross-screen measurement. So that report will be coming out in time for this webinar in a couple of weeks. There's a link to registration that's being shared with you now, as well as in our newsletter today. So that's our next hot topic, and we'll be pulling together that whole program for you over the next 2 weeks. But thank you again to Daniel, Charlie and Jen. Thanks for your time today, and thank you everyone for joining us.